Question 1. Title searches and examinations. The title examiner is reviewing the chain of title for a property and finds that a deed dated 5 years ago is missing from the public records. This deed was crucial in establishing a clear transfer of ownership from a previous owner. What is the most appropriate action the title examiner should take to address this issue? A. Ignore the missing deed and proceed with the title insurance commitment. B. Issue a title policy with a specific exception for the missing deed. C. Initiate a quiet title action to correct the chain of title. D. Contact the previous owner to obtain a copy of the missing deed. Answer. C. Initiate a quiet title action to correct the chain of title. Explanation. When a deed is missing from the public records but is essential for establishing a clear chain of title, the most appropriate course of action is to initiate a quiet title action. This legal process aims to resolve any disputes or uncertainties about the title and to confirm the ownership of the property. Ignoring the issue or issuing a policy with an exception does not resolve the underlying problem. Contacting the previous owner may be a step in gathering information, but it does not address the legal need for clear and unbroken title documentation. According to title insurance regulations, ensuring a clear chain of title is crucial for providing coverage and protecting the interests of the policyholder. Question 2. Title insurance policies. Which of the following statements best describes the difference between standard coverage and extended coverage in title insurance policies? A. Standard coverage includes protection against defects found in public records, while extended coverage also covers risks such as zoning violations and unrecorded liens. B. Standard coverage protects against all possible title defects, whereas extended coverage is limited to specific exclusions and exceptions. C. Extended coverage includes protection against defects found in public records, while standard coverage only protects against defects that are recorded. D. Extended coverage protects against defects found in public records and unrecorded liens, while standard coverage does not include protection against zoning violations. Answer. A. Standard coverage includes protection against defects found in public records, while extended coverage also covers risks such as zoning violations and unrecorded liens. Explanation. Standard title insurance coverage typically protects against defects that are found in public records, such as unrecorded deeds or errors in recorded documents. Extended coverage goes beyond this by including protection against additional risks like zoning violations and unrecorded liens that may affect the property's use or value. This broader coverage is essential for addressing more complex issues that might not be evident from public records alone. Understanding the differences between these coverage types is important for selecting the appropriate policy based on the specific needs and risks associated with a property. Question 3. Scenario-based question. MS. Thompson is purchasing a commercial property and the title search reveals an easement recorded in 1985 that was not disclosed by the seller. The easement grants access to a neighboring property owner for a specific use. How should MS. Thompson proceed with the title insurance commitment in light of this undisclosed easement? A. Proceed with the title insurance commitment without addressing the easement as it is recorded and publicly accessible. B. Reject the title commitment and request a new search to ensure there are no additional undisclosed easements. C. Accept the title commitment but request an endorsement to cover the potential impact of the easement on the property's use. D. Negotiate with the neighboring property owner to remove the easement from the title. Answer. C. Accept the title commitment but request an endorsement to cover the potential impact of the easement on the property's use. Explanation. In this scenario, MS. Thompson should accept the title commitment while requesting an endorsement to address the impact of the undisclosed easement on her property's use. An endorsement can provide additional coverage or clarify the extent of the impact of the easement which may affect the property's value or intended use. Simply proceeding without addressing the issue does not protect MS. Thompson from potential risks. Rejecting the commitment and requesting a new search might be unnecessary if the easement is already recorded and known. Negotiating with the neighboring property owner to remove the easement might not be feasible or necessary, especially if the endorsement provides adequate protection. Question 4. Real property law and legal concepts. Which of the following is NOT a typical characteristic of a fee simple absolute estate? A. It is inheritable and can be passed down to heirs. B. It is subject to government regulations such as zoning laws. C. It includes the right to sell, lease, or transfer the property. D. It is limited by a condition that could potentially terminate the estate. Answer. D. It is limited by a condition that could potentially terminate the estate. Explanation: a fee simple absolute estate is the highest form of property ownership and is characterized by its inheritable nature, ability to be sold or transferred, and freedom from conditions that could terminate the estate. Unlike fee simple determinable or fee simple subject to a condition subsequent, which can be limited by conditions that may cause the estate to end, a fee simple absolute provides complete ownership rights without such limitations. Understanding these distinctions is crucial for assessing property rights and ownership. Question 5. Title searches and examinations. During a title search, you discover an old mortgage lien that was never fully released from the public records despite the mortgage having been paid off years ago. What is the most appropriate way to resolve this issue? A. Ignore the lien and proceed with the title commitment as the mortgage is no longer active. B. Request a release of lien from the mortgagee and record it to clear the title. C. Proceed with the title commitment but include an exception for the old mortgage lien. D. Advise the buyer to obtain title insurance that specifically excludes the lien. Answer: B. Request a release of lien from the mortgagee and record it to clear the title. Explanation: when a mortgage lien remains on record despite being paid off, it can create potential issues for new owners or lenders. The most appropriate action is to request a formal release of lien from the mortgagee and ensure it is recorded in the public records. This action clears the title and ensures that the lien does not affect future transactions or create legal complications. Ignoring the lien or including an exception may not fully resolve the issue, and advising exclusion from coverage does not address the need for accurate public records. Question 6. Title insurance regulations and compliance. Under the Real Estate Settlement Procedures Act (RESPA), which of the following practices is considered? A violation: A. Providing a disclosure of the estimated settlement charges within 3 business days of receiving the loan application. B. Accepting a referral fee from a service provider, such as a title company, in exchange for directing business to them. C. Requiring the borrower to use a specific title insurance company as a condition for obtaining a mortgage loan. D. Offering a credit towards settlement costs as part of a promotional incentive to the borrower. Answer: B. Accepting a referral fee from a service provider, such as a title company, in exchange for directing business to them. Explanation: SPA regulates practices related to settlement services and prohibits kickbacks or referral fees between service providers, including title companies. Accepting a fee for directing business violates SPA and can result in legal penalties. Providing timely disclosures, requiring the use of a title company as a condition of the loan, and offering promotional credits are generally compliant with SPA regulations as long as they are disclosed properly. Question 7. Title insurance policies. Which of the following is typically not covered by a standard title insurance policy? A. Errors or omissions in the public records. B. Zoning violations that affect the property's use. C. Unrecorded liens that were created prior to the policy issuance. D. Forgery or fraud affecting the title. Answer: B. Zoning violations that affect the property's use. Explanation: a standard title insurance policy typically covers defects such as errors or omissions in the public records, unrecorded liens that were created before the policy issuance, and issues like forgery or fraud. However, zoning violations, which relate to land use and local government regulations, are generally not covered under a standard policy. Extended coverage or endorsements may be required to address such risks. Understanding these coverage limits is essential for evaluating the protection offered by a title insurance policy. Question 8. Title insurance underwriting. When underwriting a title insurance policy for a commercial property, which factor is most critical in assessing the risk associated with the property? A. The property's historical use and zoning compliance. B. The age of the property's construction. C. The property's current market value. D. The personal background of the property owner. Answer: A. The property's historical use and zoning compliance. Explanation: in commercial property underwriting, assessing the historical use and zoning compliance is crucial as it impacts the property's current and future use and value. Historical use can reveal potential risks such as environmental issues or legal non-compliance, while zoning compliance ensures the property adheres to local regulations. The property's age, market value, and the owner's background are less directly related to the specific risks associated with title insurance underwriting. Question 9. Closing and settlement procedures. In the closing process, which document is primarily responsible for outlining the distribution of settlement funds and the payment of outstanding liens? A. Title commitment. B. HUD-1 settlement statement. C. Deed of trust. D. Title insurance policy. Answer: B. HUD-1 Settlement Statement. Explanation: the HUD-1 Settlement Statement is the document that details the distribution of settlement funds and the payment of outstanding liens during the closing process. It provides a comprehensive breakdown of all costs associated with the transaction, including the disbursement of funds. The title commitment outlines the terms of the title insurance. The deed of trust secures the mortgage loan, and the title insurance policy provides coverage against title defects but does not detail settlement fund distribution. Question 10. Ethics and professional responsibility. Which of the following actions is considered an ethical breach for a title insurance professional under ALSA's principles of ethical conduct? A. Providing accurate and complete information about the title and its coverage to clients. B. Engaging in business practices that prioritize the interests of clients over personal gain. C. Offering gifts or incentives to real estate agents in exchange for referrals. D. Maintaining confidentiality of client information in accordance with privacy laws. Answer: C. Offering gifts or incentives to real estate agents in exchange for referrals. Explanation: offering gifts or incentives to real estate agents in exchange for referrals is considered an ethical breach under ALSA's principles of ethical conduct. Such practices can create conflicts of interest and compromise the integrity of the title insurance process. Providing accurate information, prioritizing client interests, and maintaining confidentiality are aligned with ethical standards and promote trust and professionalism in the industry. Question 11. Fundamentals of title insurance. Which of the following best describes the primary purpose of title insurance? A. To guarantee that the property is free of any current physical defects. B. To provide protection against legal claims and defects affecting the title that existed prior to the policy issuance. C. To ensure that the property conforms to local building codes and regulations. D. To offer financial compensation for damage caused by natural disasters. Answer: B. To provide protection against legal claims and defects affecting the title that existed prior to the policy issuance. Explanation: the primary purpose of title insurance is to protect against legal claims and defects affecting the title that existed before the policy was issued. This includes issues such as undisclosed liens, fraud, or errors in public records. It does not cover physical defects of the property, compliance with building codes, or damage from natural disasters. Understanding this core function is essential for both title professionals and policyholders. Question 12. Real property law and legal concepts. A property owner has the right to build a fence that encroaches onto a neighboring property. This right is an example of A. Easement in gross, B. Encroachment, C. License, D. Adverse possession. Answer: B. Encroachment. Explanation: encroachment occurs when a property owner builds something that extends beyond their property lines onto a neighbor's property. Unlike an easement or license, which are legal rights granted to use someone else's property in specific ways, encroachment is an unapproved intrusion. Adverse possession involves claiming ownership of land based on continuous and open use, while an easement engrosses a right to use the property for a specific purpose. Question 13. Title searches and examinations. If a title search reveals a judgment lien against the seller, what should be the next step before proceeding with the sale? A. Ignore the lien if the seller assures it will be resolved. B. Proceed with the sale and have the buyer accept the lien in the title insurance policy. C. Ensure the lien is paid off and removed from the public records before completing the sale. D. Include a disclaimer in the sale agreement that the lien is the buyer's responsibility. Answer: C. Ensure the lien is paid off and removed from the public records before completing the sale. Explanation: a judgment lien must be resolved before completing the sale to ensure that it does not affect the new owner's title. This typically involves paying off the lien and obtaining a release or satisfaction of the lien, which should then be recorded. Ignoring the lien or placing responsibility on the buyer could lead to legal disputes or complications. Ensuring the lien is cleared is crucial for providing a clear and marketable title. Question 14. Title commitments. Which of the following items would you typically find in Schedule B of a title commitment? A. The legal description of the property and the names of the parties involved. B. The title insurance policy coverage limits and exclusions. C. Exceptions to coverage such as easements, restrictions, or encroachments. D. Requirements for issuing the title insurance policy. Answer: C. Exceptions to coverage such as easements, restrictions, or encroachments. Explanation: Schedule B of a title commitment lists exceptions and exclusions from coverage, including specific items such as easements, restrictions, or encroachments that may affect the property. Schedule It includes details like the legal description of the property and parties involved, while the title insurance policy coverage and issuance requirements are addressed separately. Question 15. Title insurance policies. Which of the following is a common exclusion found in most standard title insurance policies? A. Losses due to title defects that were known and disclosed prior to policy issuance. B. Losses arising from claims of fraud or forgery discovered after policy issuance. C. Losses due to zoning or land use violations. D. Losses resulting from a recorded deed that was not properly executed. Answer: C. Losses due to zoning or land use violations. Explanation: Standard title insurance policies commonly exclude coverage for losses resulting from zoning or land use violations. These issues pertain to regulatory compliance rather than defects in the title. Known and disclosed defects, fraud, and improperly executed deeds are generally covered under different policy provisions or endorsements. Question 16. Title insurance regulations and compliance. Which regulation mandates that title insurance companies provide a good faith estimate (GA) of settlement costs to borrowers? A. Dodd-Frank Act. B. Real Estate Settlement Procedures Act, RISPA. C. American Land Title Association Alta Standards. D. Consumer Financial Protection Bureau, CAB rules. Answer: B. Real Estate Settlement Procedures Act, RISPA. Explanation: RESPA requires title insurance companies and other settlement service providers to provide a good faith estimate (GA) of settlement costs to borrowers within 3 business days of receiving a loan application. This regulation aims to ensure transparency and prevent unexpected charges. The Dodd-Frank Act and CFPB rules also impact settlement practices, but the GFE requirement is specifically mandated by RESPA. Question 17. Title insurance underwriting. In underwriting a title insurance policy for a residential property, which factor is least likely to affect the underwriting decision? A. The property's zoning classification. B. The current market conditions and property value. C. The buyer's credit score and financial history. D. The history of title defects or claims on the property. Answer: C. The buyer's credit score and financial history. Explanation: In title insurance underwriting, the focus is on the property's title history, potential defects, and compliance with regulations rather than the buyer's credit score and financial history. While creditworthiness is important for mortgage underwriting, title insurance underwriting is concerned with the property's title status and associated risks. Question 18. Closing and settlement procedures. At closing, which document serves to verify that all terms of the sale have been met and that the title will be transferred to the buyer? A. Title insurance policy. B. Deed of trust. C. Closing disclosure. D. Escrow agreement. Answer: C. Closing disclosure. Explanation: The closing disclosure is the document that provides a detailed summary of all terms of the sale, including financial details and settlement costs, ensuring that everything agreed upon is accounted for and that the title will be properly transferred to the buyer. The title insurance policy provides coverage for title defects, the deed of trust secures the loan, and the escrow agreement outlines the terms of escrow but does not confirm the completion of the transaction. Question 19. Claims handling in title insurance. If a title insurance claim is filed due to an undisclosed heir claiming ownership of the property, what is the typical process for handling this claim? A. The title insurance company denies the claim, as undisclosed heirs are not covered. B. The title insurance company investigates the claim and may provide legal defense or settlement if coverage applies. C. The claimant is advised to resolve the issue through private negotiation with the property owner. D. The title insurance company automatically pays the claim without further investigation. Answer: B. The title insurance company investigates the claim and may provide legal defense or settlement if coverage applies. Explanation: When a claim is filed due to an undisclosed heir, the title insurance company will investigate the claim to determine if it falls under the policy coverage. If the claim is valid, the company may provide legal defense and or settle the claim according to the policy terms. Title insurance is designed to address such issues, not automatically deny them or resolve them through private negotiation. Question 20. Ethics and professional responsibility. Which practice would most likely be considered a conflict of interest for a title insurance professional? A. Providing detailed information to clients about potential title issues and risks. B. Accepting compensation from a third party for recommending their services without disclosure. C. Ensuring that all title insurance policies meet regulatory standards and guidelines. D. Maintaining transparency in all communications with clients and other parties. Answer: B. Accepting compensation from a third party for recommending their services without disclosure. Explanation: accepting compensation from a third party for recommending their services without proper disclosure constitutes a conflict of interest and violates ethical standards. It can compromise the impartiality and integrity of the title insurance professional. Providing information, ensuring regulatory compliance, and maintaining transparency are all practices aligned with ethical conduct. Question 21. Title searches and examinations. During a title search, a title examiner discovers a mortgage that was released but not properly recorded. What is the most appropriate course of action to address this issue? A. Ignore the mortgage as it is no longer active and proceed with the transaction. B. Obtain a release document from the lender and ensure it is recorded correctly before closing. C. Include a note in the title report stating that the mortgage was not recorded. D. Advise the buyer to obtain a separate title insurance policy for the mortgage issue. Answer: B. Obtain a release document from the lender and ensure it is recorded correctly before closing. Explanation: a mortgage that was released but not properly recorded can still create a cloud on the title. To clear this issue, the title examiner should obtain a release document from the lender and ensure it is recorded correctly. This action ensures that the title is clear of any encumbrances before closing. Ignoring or simply noting the issue does not address the problem, and obtaining a separate policy does not resolve the underlying issue. Question 22. Title insurance policies. Which of the following statements accurately describes the difference between a standard title insurance policy and an extended coverage policy? A. An extended coverage policy includes additional protections for zoning violations that are not covered by a standard policy. B. A standard policy covers all potential risks, while an extended policy excludes certain risks. C. An extended coverage policy provides protection against risks such as unrecorded liens and encroachments which are not covered by a standard policy. D. A standard policy offers coverage for all risks, including those identified in a title search, while an extended policy only covers specific risks. Answer: C. An extended coverage policy provides protection against risks such as unrecorded liens and encroachments which are not covered by a standard policy. Explanation: an extended coverage policy offers broader protection than a standard title insurance policy, including coverage for additional risks such as unrecorded liens and encroachments. Standard policies generally provide coverage for risks that are revealed by a title search but do not include these extended protections. Understanding these differences is crucial for selecting the appropriate policy based on the property's specific risks. Question 23. Real property law and legal concepts. Which of the following best describes the concept of an easement by necessity? A. An easement granted voluntarily by a property owner for a specific purpose. B. An easement established through a written agreement between property owners. C. An easement that arises when a property is landlocked and requires access over another property to reach a public road. D. An easement that automatically terminates when the necessity no longer exists. Answer: C. An easement that arises when a property is landlocked and requires access over another property to reach a public road. Explanation: an easement by necessity is a type of easement that arises when a property is landlocked and requires access over a neighboring property to reach a public road or utility. It is not granted voluntarily but arises out of necessity. This easement typically terminates once the necessity for it ceases to exist. Understanding this concept helps in assessing property access issues and rights. Question 24. Title insurance underwriting. When underwriting a title insurance policy for a commercial property, what factor is least likely to impact the underwriting decision? A. The property's zoning and land use regulations. B. The financial stability of the commercial tenant leasing the property. C. The history of title defects or claims associated with the property. D. The physical condition of the property's structures. Answer: B. The financial stability of the commercial tenant lease in the property. Explanation: in underwriting a title insurance policy, the focus is primarily on title-related issues such as zoning regulations, title defects, and legal claims rather than the financial stability of tenants. While tenant stability can affect property value and income, it does not impact the title insurance underwriting process directly. Question 25. Title commitments. Which of the following best describes the purpose of Schedule C in a title commitment? A. To list the legal description of the property and the parties involved in the transaction. B. To outline any exceptions and exclusions from the title insurance coverage. C. To detail the requirements and conditions that must be met before issuing the title insurance policy. D. To provide a summary of the title search findings and any issues that need to be addressed. Answer: D. To provide a summary of the title search findings and any issues that need to be addressed. Explanation: Schedule C of the title commitment provides a summary of the title search findings and highlights any issues or requirements that must be resolved before issuing the final title insurance policy. It does not include legal descriptions, exceptions, or general requirements which are covered in other sections of the commitment. Question 26. Closing and settlement procedures. Which document is used to confirm the final distribution of funds and the payoff of existing liens at closing? A. Title insurance policy. B. HUD-1 settlement statement. C. Closing disclosure. D. Deed of trust. Answer: B. HUD-1 settlement statement. Explanation: The HUD-1 settlement statement, also known as the settlement statement, confirms the final distribution of funds and the payoff of existing liens at closing. This document details all financial transactions related to the sale, including the disbursement of funds. The title insurance policy and closing disclosure provide different types of information, and the deed of trust is related to securing the loan rather than settling funds. Question 27. Claims handling in title insurance. If a title insurance company is faced with a claim involving a forgery that was not discovered until after policy issuance, what is the company's most likely response? A. Deny the claim outright, as forgery is never covered. B. Investigate the claim to determine if it falls under the policy's coverage and provide defense or settlement if applicable. C. Require the policyholder to resolve the issue independently without support. D. Automatically pay the claim without investigation. Answer: B. Investigate the claim to determine if it falls under the policy's coverage and provide defense or settlement if applicable. Explanation: When a forgery claim arises after policy issuance, the title insurance company will investigate to determine whether the claim is covered by the policy. If the forgery is a covered risk, the company will provide defense and or settlement according to the policy terms. Automatic payment or denial without investigation is not consistent with standard practices. Question 28. Title insurance regulations and compliance. Which federal regulation requires title insurance companies to provide a detailed breakdown of settlement costs to the borrower? A. Dodd-Frank Act. B. Real Estate Settlement Procedures Act, RISPA. C. Truth in Lending Act, TILA. D. Consumer Financial Protection Bureau, CAB rules. Answer: B. Real Estate Settlement Procedures Act, RISPA. Explanation: I. SPA mandates that title insurance companies and other settlement service providers furnish a detailed breakdown of settlement costs to the borrower through the good faith estimate (GA) and closing disclosure. This regulation ensures transparency in the settlement process. The Dodd-Frank Act and CFPB rules also impact settlement practices but are not specifically responsible for the breakdown of costs. Question 29. Ethics and professional responsibility. What is considered an ethical responsibility of a title insurance professional when handling sensitive information? A. Sharing information with other professionals without client consent to expedite transactions. B. Maintaining strict confidentiality and only sharing information with authorized parties. C. Using client information for personal or professional gain. D. Discussing client information openly in professional forums for educational purposes. Answer: B. Maintaining strict confidentiality and only sharing information with authorized parties. Explanation: Ethical responsibilities include maintaining strict confidentiality of client information and only sharing it with authorized parties as necessary for the transaction. Sharing information without consent or using it for personal gain violates ethical standards. Discussions in professional forums should not disclose sensitive client information. Question 30. Specialized areas in title insurance. When dealing with title insurance for new construction, which of the following factors is crucial for underwriting? A. The financial history of the construction company. B. The zoning classification of the property. C. The status of any existing liens or encumbrances on the property before construction began. D. The design and aesthetics of the new construction project. Answer: C. The status of any existing liens or encumbrances on the property before construction began. Explanation: For title insurance in new construction, it is crucial to review the status of any existing liens or encumbrances on the property prior to the start of construction. This ensures that the title is clear and free of claims that could affect the new construction. The financial history of the construction company and the design of the project, while important, are not directly related to title insurance underwriting.